Good afternoon to everybody for joining us out there today. We're happy to be hosting our third quarter webinar titled The Fed's Gambit. Unique title Robert chose for us there, and he'll get into more detail on that. We understand the first 3 quarters of this year have been some very trying times, to say the least, not only for the advisors, but your clients out there. So we hear you loud and clear, and we believe today we're going to have some great takeaways for you to take back to your clients, maybe a couple visuals within the charts that are also great. We have a lot to cover, so we want to get into this rather quickly. Our agenda is up on the screen here today. We're going to talk a little bit, like we always do, like to touch a little bit on part of our investment process, how it's adapted a little bit to these markets as they've been changing and evolving. And then Joy is going to jump into a performance review for us over the quarter, and you'll be able to see the year-to-date numbers as well. And then we're going to switch it back over to Robert, who's going to just give us a little bit of the history and forward-looking things to think about, and maybe some talking points to share with your clients as to why they might want to stay invested. And then we're going to finish up. We have had a lot of questions. We're going to touch on as many of those as we can. If we do not get to your questions, we will make sure and follow up and have an answer for you via a phone call. So with that, before I turn it over, we do want to make sure we hear from you. So there's a survey at the end. Please make sure to take just a couple minutes to fill that up. Also, throughout the program, if there's something you don't understand or you have some questions on the slides, there's a chat function. Feel free to ask us any questions via either the Q&A function or the chat function. And then also throughout the program, we're going to be posting some of our content out there for you that will be available for you to have some takeaways right after this program. And so without further ado, why don't we pop up a poll question here and see what we have on the agenda today. So the first question is going to be, what's the biggest problem for the global markets? So we'll give you a few seconds to answer that. And waiting for those results to pop up for us. It looks like the winner is central bank policy. So I think everybody has inflation and interest rates on their mind. So with that, why don't I turn it over to Chief Investment Officer Robert Michaud to give us a little bit of insight there. Thanks, Robert.
All right, thanks, Jesse. That might have been my choice for the poll too, but you know, we're here. This is the third quarter where markets are down. It's not fun to talk like this and be in our situations and talk to investors in any market when quarters are down. And 3 in a row is certainly painful. So we do take time to reflect. What could we have done better? It's always, we understand that there is no crystal ball. It's all about what you know at the time, and are you making good choices, a thoughtful process, and is our investment processes still functioning the way they should be? And so it's important to reevaluate things and to make sure that you're doing the best job you can. And so, you know, but after you've beaten yourself up a little bit, you have to decide, well, what's the best thing to do going forward? And acknowledge that every quarter is a little bit of a coin flip. And what we're trying to do is make sure that the odds are as much in your favor as possible. So how can we do that? And especially during emotional times, I think it's really important to go back to investment fundamentals and what can you do to add value, and how can you make sure that you are doing the best job possible of building portfolios for investment objectives. And so we've talked a little bit in the past about investing in an uncertain future. How do you optimize portfolios? How do you think about rebalancing portfolios? And so today I really wanted to talk about how you build capital market expectations in an environment that has changed so much over the last year. So we start with our investment philosophy, right? Our investment philosophy philosophy is not about speculating on the future or picking a best asset class. It is really thinking about what are the investment opportunities out there, what are the viable asset classes for investors to invest in, understand the risk and return of the various asset classes, how they adapt and change over time. And then once you understand the investment opportunities and how they relate to each other and what the rewards and risks are, then you can build an optimized portfolio. You can build the right portfolio for different investors and their objectives. So how do we build capital market expectations? So one important component is historical information. And when you think about historical information, there's all these past returns. We all know past returns don't predict future very well at all. But so what information is there? Well, there's a lot of value in terms of looking at history to understand the risk of the future. This year makes you question that a little bit, and or maybe a lot, because we've certainly blown through any historical volatility observations for bonds, for instance, this year than in the past. But we do understand how assets move together. The correlations is valuable, but the return expectations are not so much. So how do you build better return expectations, for instance, in a changing environment? Well, it's important to add to history a couple of things. One is what you understand about risk and return relationships from academic research and economic theory, and how these things have to vaguely work together. The other thing is, what's the market telling you right now? What is all the currently available information, and things like the yield curve, credit spreads, volatility, shorter term estimates of some of these things also are very important signals to incorporate. And so what we do is we use modern statistics to separate some of the signal from the noise of historical data. And then we plug this into what is called a Bayesian statistical framework, which is really the proper mathematical framework for incorporating many different sources of information to come up with one mathematically consistent output. So one set of capital market expectations that allow you to really say, well, how much do you believe these various sources of information coming in? So I wanted to show you sort of how this actually worked at the end of last year. And so I took a sampling of 8 easily recognizable and understandable asset classes. And so the first line is what the historical returns were for these asset classes. You can look at the bonds. You can see the bonds had pretty high historical returns, and the stocks had actually historical returns these are over the last 20 years. They were positive, but all over the place. And so you don't want to invest with those assumptions, obviously. So the second step is to improve what history says by separating the signal from the noise, and that's the brown line in the middle. And there you see that some of these outliers and on both up and low are pulled in, and you have something that looks a little bit more regular, but still not very useful for investing. And so then the light green bar is what happens to these estimates when you actually add in the information. And you see that, for instance, the 4 on the left, the fixed income asset classes, especially the treasuries, are dramatically brought down to what we thought were more realistic levels at the end of last year, based on how they had done historically. And this is a lot to do with current yields, credit spreads, especially on the fixed income side. On the equity side, you see that they're once again brought into, maybe there's some relationship between risk and return. Maybe the US markets have slightly higher expected return than international markets, but they're mostly in line and mostly compatible. And so that's what you're looking to do. And then as information changes, we can change these as well. So then I wanted to show you, well, what happens after a year where these are not exactly our current estimates. This is, a sort of a diagram. There are no numbers, as you have, I'm sure, noticed. But as you go from the beginning of the year, where interest rates were very low and expectations going forward for bonds were very low, to more of the current situation, and you see that things have changed a lot. You can see the flat yield curve in action. You can see some of the credit spreads changing as well. So this is how you change just some of the fundamental inputs into an optimization. So then I wanted to next talk about how this has impacted our portfolios. And going back to actually the start of before markets started being quite so unpleasant for investors, what had we actually done? And we had done some reasonable things at the time. At the beginning of the year, or even before the beginning of the year, we recognized that China had really changed its character from being a positive to a negative with its COVID-0 policy, and it was hurting its own economy and not rewarding investors through regulations. And so we removed that. That wasn't speculative about is China a good or a bad stock market in some sense, will it go up or down, but it was more thinking about, is it going to reward investors effectively? Then we were thinking about the really big question on our mind was bonds and bond volatility. And we were thinking about this everybody was thinking about this a year ago. The question was what to do about it. And so we changed our model of historical volatility for fixed income to include much higher risks and volatility going forward. And then we needed a way of incorporating that into our portfolio. And so we wanted to take some of the risk away from bonds and move it to stocks, and without it just increasing the risk of the portfolio. So we added some min-vol equities, IFA min-vol, in addition to US min-vol, and allowed the portfolio to naturally shift its risk characteristics that way as well. So we did that at the turn of the year. We continued to do that over the course of the year. What this meant was that coming into the year, we had our lowest allocation to long treasuries, for example, as we ever had. Not as low as we would like in hindsight, but it was the lowest that we'd ever had. And as things unfolded, we continued to move in that direction. And so this last quarter, we only had one rebalance. We rebalanced for our tax-sensitive portfolio. You can see in late June, we rebalanced many of our other portfolios. And there was a similar continuation there as well, where there was even more clear volatility coming from fixed income markets. We reduced duration a little bit more, shifting towards credit, and if we could, into more reliable equities as well. So those were the general changes. The other thing that was really dramatic was because interest rates were so much higher, that means that fixed income for taxable investors was a very different picture. And so what we found was that certain asset classes that had made sense in very small measured amounts before in a taxable portfolio, like TIPS, were no longer tax efficient at all because they were kicking off so much highly taxable income. So I'd like to stop here, and we can let Joy show you what has happened to our portfolios over the last quarter.
Great, thank you, Robert. And thanks again, everyone, for taking your time to join us today. I'm Joy Jen, Senior Research Analyst at New Frontier. So today, I will be giving you the summary of the third quarter's performance, covering broad markets, asset classes we're currently investing, and our portfolio performance. So as we said, this is a challenging time for all of us. So hopefully I can share some talking points with you for your conversations with your clients. So markets were down 3 quarters in a row. And what happened during the third quarter is that after a bad second quarter, we had a bear market rally where people are really hoping that the worst had been priced in and the Fed might soften its aggressive stance. But none of this happened. Inflation is still there. We still have aggressive Fed, and geopolitical tensions are still with us. And as a result, global equities fell 16% from that high. And bond markets also experienced a similar reversal. And what makes this year so unique in history is that for the first time in the last 40 years, both stocks and bonds declined substantially and entered bear markets simultaneously. So in this chart, I plotted annual returns for S&P 500 and US Ag from 1980 to 2022, with horizontal axis representing US Ag and vertical axis for S&P. So each point in this chart represents annual return for stock and bond for a given year. So for the majority of the years, we can see from the chart, we have both positive stock and bond return. For some of the years here, when stocks declined, for example, in 2008, stocks lost 37%, but bonds were up, providing the protection, also mitigating losses in a multi-asset portfolio. And here we are in 2020 in this double down quadrant. And you can see from the chart, bonds are also having the worst year ever. So what that means is that even though stocks haven't declined as much as they did in 2008, the total global wealth, combining stocks and bonds, are experiencing historical losses. So the average 60-40 or 50-50 investments are having the biggest losses ever. And this is unprecedented. And apparently this is affecting all of us. And given how stocks and bonds have performed this year, the long-term negative correlation between stocks and bonds have turned positive this year. And not only US Treasuries, but also other fixed income. Their correlations with stocks have increased a lot this year, like mortgage, from almost zero correlation to a high correlation. But still, these short-term relationships will eventually revert to the historical norm over time when markets reach a new equilibrium. And against this backdrop, we have fixed income performance here, and fixed income continued to be under pressure, very similar to the first half of the year. And we have Q1, Q2, Q3 performance for fixed income assets. So for this quarter, high yield remained resilient, with short high yield being the best performing fixed income for the quarter. Municipal bonds down 3%, better than other taxable bonds. And on the other hand, long duration still hurt, down 10%, and international treasuries down almost 10% due to stronger dollar. On the equity side, US equities managed a comeback after second quarter's massive sell-off. So even though they're still down 5% across the board, they did better than international equities. While value outperformed growth for the year by more than 20%, this quarter, value and high dividend stocks, they underperformed growth slightly. And small cap growth was the best performing stock for the quarter. On the other hand, European equities, emerging equities, and international REITs were down 12 to 13% and were among the worst performing equities. So when we talk about our performance attribution, I think it's important to remember that our underweight and overweight exposure are very different across the frontier because of how we optimize the risk exposure according to the risk mandate. And for example, for our aggressive portfolios, they benefited from overweight in US small cap growth, but at the same time were hurt from overweight in risky emerging equities and international REITs. And on the other hand, the more conservative portfolios like 2080, they benefited from overweight in US stocks in general and underweight in risky international exposure. So that leads to our portfolio performance. And here I'm showing you net of fees performance of different time periods for global core, tax sensitive, and multi-asset income. And you can access our performance data through performance sheets shared in the chat box and also through our website. So for this quarter, portfolios were down 4 to 7%, depending on the risk profile. And this for sure a very challenging quarter and a tough year for investing. So I think the way to think about this is that it's unprecedented. And given how special it is, if you are a 60-40 investor, and in this particular time, if you sell and go to cash, you're guaranteed to lock in the biggest losses ever. So I think it's really about trading short-term discomfort for long-term gain and focusing on long-term wealth accumulation that matters for your wealth. And for income investors, multi-asset income portfolios are providing yields up to 5% this year, which is much higher than before. And as we're approaching year end, conversations about taxes are coming up. So on top of this year's performance, I think the last thing you want is a surprise tax bill. So for the end of my section, I want to share 3 takeaways with you. 1, our tax-sensitive portfolios have distributed nearly 0% capital gains since its inception, regardless of up or down markets. So here I'm showing you 60-40, for example, short-term and long-term capital gains. And this year, none of our portfolios have distributed any capital gains. And second, this is not necessarily true for other mutual funds this year because of large redemptions. And third, mutual fund in the 50 to 70% equity Morningstar category, you can think of a 60-40 mutual fund, have the average of the tax cost of 2% for the 1-year return. That means a 2% loss due to income taxes for your 1-year return as of Q3. And this is not a small amount. And Robert will also talk about tax management in his section later. So with that, I will pass over to Jesse. Thank you.
Well, thanks, Joy, for an interesting performance update. I don't think there's a lot of surprises there, as everybody's continued to mention. It has been some tough times. We feel your pain out there as well. I think we have another poll question here before we turn it back over to Robert to give us kind of an outlook. This one's around actually modifying investment plans. The current economic conditions made you and your clients consider modifying your current investment plan. So just a few seconds, if you wouldn't mind answering that. We'll see what everybody's saying. And it looks like, no, we're going to stay in the current portfolio, appears to be the common answer. So it sounds like we may have taught you well. So we appreciate the information there. And with that, why don't we turn it over to Robert to give us some insight to the markets, both past, present, and future.
All right, well, thanks, Jesse. I want to start here. I can plan on building on those 2 polls actually and talk about, in the first part, I would like to say what's going on in markets right now, what are the forces driving things, and then in the second part, what can we do about it and as investors. And so for the big picture, I want to go over the things that are threatening the global economy and affecting markets. One thing I won't be talking about really is politics. For better or for worse, prediction markets are saying there's a 80% chance of a significant regime change in Washington in the midterms. And the other thing to understand there, though, is that they don't particularly affect markets. There are sometimes a short blip, but politics and markets are 2 separate things. So, and the most important person in Washington right now isn't up for re-election, and Powell is a Republican, and so again, I don't think the politics are going to affect anything right now. So let's look globally. These are all things that you know about. I don't want to talk too much about rehashing all of the headlines of the news. But I think there's some serious parallels there, which are the 3 main economic regions of the world all have serious issues. They're all different types of issues. They're all, to some extent, self-inflicted, although it's really unfair to Europe to say that Russia was self-inflicted. But they're unlike zero COVID policies or Feds getting overly aggressive. But they are impacting their own economies, and they are also, of course, impacting the global economy. So China is very much focused on regulations and control. They don't care about economic growth, or at least that's how they seem. And this is impacting and making inflation worse through low production. In Ukraine, the energy crisis is also not only contributing to commodity inflation, but also to a lesser extent, low production. And here in the US, we're desperately raising interest rates as fast as we can to cool off the labor and consumer markets. And this is feeding inflation. This is, raising interest rates and causing market volatility, not just for us, but for the rest of the world. So inflation seems to be central to a lot of this. I want to remind you that it is a global phenomenon. There's a lot of inflation in a lot of other countries. It's not just internal US policies that have created inflation. And in terms of, has it slowed down? Maybe is the answer that everyone has, but it's not fast enough. And of course, what are we expecting? It takes a while for the impact of rate hikes to go from raising rates to impacting decisions to actually eventually trickling through the economy. And these are going to be happening at different rates in different parts of the world. And also, the solution for the US is not necessarily the solution for other economies. And there's some concern about every central bank, or not, except for a very few exceptions, raising rates, and perhaps they need different solutions. So just again, it makes sense to ask yourself, is inflation really the right question? There's some concern that the Fed is paying too much attention to one particular number and not thinking about what the real market dynamic is. Just very briefly, the recession concerns look like they're about the same as they were before, which is that it's possible in the future. We're not in one necessarily right now. And so what should we do? Well, this goes to the Fed, and the Fed is in a very difficult situation. There isn't an easy solution to this. They have the problem of stubbornly high inflation, and it's their job to fight inflation. And if you're faced with this situation, what can you do? And they've done something that's a little bit radical, and they've said they are dropping their normal mandate to care about the economy and employment and inflation at the same time, and say, no, they're only going to focus on inflation. And why would they do this? Why would they deliberately harm the economy? And they've certainly hurt asset prices a lot in this pursuit. And I think they think it's their only choice. And as an economist, and you like game theory, and you might want to analyze the situation from a game theory perspective, which is, if they can, how do they win in this situation? They have to convince markets that they're so serious that they will do anything it takes to bring inflation down, maintain their credibility, and they don't care who's hurt along the way. If the economy believes that they're actually going to go that far, then it makes sense for consumers to slow down purchases and start saving a little bit more for a rainy day, and for corporations to do the same thing in terms of hiring. And that would reduce the stresses, the two main stresses on inflation, and is a path to a soft landing where sort of everyone wins as much as they can. Of course, it can, so that's the thing that we're hoping for. And the thing that we're not hoping for is that the economy keeps doing what it has been doing and doesn't pay attention to the Fed. And then the Fed just keeps raising inflation more and more and more until we're definitely headed into a recession. The other thing that could happen is that, and that is likely, we've seen it happen before, that if you raise rates enough, you will slow down the economy a lot and bring down inflation. The other side is what happens if there's some pressure, or they lose their nerve, or they pay attention to markets or the economy, and they don't keep raising rates. Well, then we may have a serious inflation here for a while. So this brings us to, how does this impact portfolio, and how should investors think about this? And I wanted to start with a thought experiment. And these are, full disclosure, these are not numbers that I want people to take home with them and make decisions based on. but they're supposed to be illustrative and in the right direction. So taking these same three scenarios from before, which again don't have equal 1/3 probabilities, but there are some sort of weights that the market has already put on it, right? The market knows about these possibilities and is trying to price assets in a competitive way so that all of this information, as best as it can, is taken into consideration. And so if, when ultimately one of these things may happen, then we'll have perhaps a different outcome for stock and bond returns. So the everyone wins as best as can solution in a normal year wouldn't sound so great, but from where we are standing now would actually be quite good. And so this is why stocks are paying so much attention to inflation news and what the Fed is saying, and get very excited whenever they think there's a chance that things will go a little better, because they're thinking about the scenario where we avoid a recession and don't have to raise rates and slow down the economy too much, which would be great for stock returns and actually kind of good for bond returns, probably. If you do have a full-on recession, well, stocks are going to get hurt more. Usually bonds do somewhat better as a defensive asset during a recession. And why aren't these numbers so much bigger, you could ask? Well, that's because the markets are already down 20-something%. And so a lot of this is already built in to the markets are kind of expecting a recession. And if you have prolonged inflation, again, why wouldn't that be such a bad scenario? Well, again, the markets are thinking that's another very real possibility, and that's already baked in. The thing is, when you add all these up, then investors have to be rewarded for taking risk, right? If investors somehow knew that markets were going to continue to go down for a long time, no one would be in the market right now. Prices would have already crashed more than they have. And then there'd be a new set of prices that would say, okay, now we're willing to have a buyer meet a seller and be willing to invest in the market going forward. So that's a little experiment. I hope that made sense. But in terms of investing right now, what does the picture look like? Well, first of all, the dollar has gone up a lot. And so the dollar going up quite so much, of course, we should be concerned that there's a lot of volatility there and uncertainty, and so it doesn't have to keep going up as much. If things reverse a little bit, then international assets could benefit. You certainly have to appreciate what it looks like from the other perspective. We've seen this massive loss of wealth globally in dollar terms. In non-dollar terms, it's even worse. Volatility works both ways. So what about bonds? With bonds, again, prices have gone down a lot. These very hard-fought higher yields that we now have are a positive going forward for bond investors. And what we have seen actually is that real yields are as high as they have been for quite a long time. These are intermediate term and longer term real yields. So this is the expected inflation over the next 5 or 10 years, taken away from the actual yield of a 5 or 10-year bond. And we see that that number is kind of positive. And so what does that mean? That means that bonds are something of a more viable asset class on their own. A year ago, I did not think that bonds were really a viable asset all on their own, but as part of a portfolio, they could make sense. Now you can think of bonds as being something of a viable asset on their own, although they still have a lot of volatility. So I'm not saying, go crazy investing in bonds. The other thing is, how does it fit into a portfolio? Well, if bonds are a more viable independent asset, then once you put them into a portfolio, they no longer have to have value merely as a hedge. And so that might mean that there could be continued positive correlation between stocks and bonds. Now, stocks are the thing that people care the most about. And so I just wanted to think about putting a reasonable context right now for how you might think about investing in stocks going forward. So recession is certainly something that is looming and people are concerned about. And so we have written this nice blog that I encourage you to read that says, well, what happens if you're investing from the start to the end of a recession? Well, of course, that's not something that anyone should intentionally do, and that would be even hard to do if you wanted to, but because recessions are often backward dated, right? The NBER is always looking, and they often declare a recession a number of months after the recession has actually started. So the real question that's much more relevant now is, given that there's been a lot of bad economic news for a while, what does it mean about investing going forward? And we sort of made a proxy for looking at past recessions and said, okay, about 2 quarters into a recession, what do stock returns look like going forward 1 year from there? And we don't know the future, of course, but that's not completely unlike the situation that we're in right now. And so what you see is that there's a lot of volatility. Sometimes there's a year like 2008 where things look really bad and they manage to get even a lot worse, and that's where you'll see things going much worse. And but on average, it's not a bad time to be an investor, and actually it's a better time on average in terms of there's more risk, there's much greater demand for capital, investors are scared, so there's a better reward for investors. Now, one important thing to bring up is that we can't control markets. No one can control markets. What's an investor to do? And so pay attention to the things that actually you can affect. And one is taxes. And what we have seen is that there have been a lot of mutual fund redemptions, 740 billion for the first 3 quarters. Extrapolate that and you have a number that looks a lot like $1 trillion, which would be pretty historic for how much money is pulled out of the mutual fund. Now, what you should think about is back to a year like 2008, where something happened where markets were down, investors pulled out of mutual funds were forced to redeem a lot of shares, and that meant selling very long-term embedded positions with capital gains. And so investors left in the mutual fund were stuck paying taxes as well as losing value that year. ETFs are different, as you know, and don't have the problem of other investors affecting them. So a down market is, for many investors, a time to consider a more tax efficient strategy, a more modern strategy to switch into. And so one thing to keep in mind is it providing enduring tax efficiency over time? And I wanted to just bring up some really neat research that we have been doing in terms of analyzing how does tax loss harvesting work over time, particularly when you do it just with a lot of stocks. You've heard of maybe tax managed equity. It sounds really attractive right now, and but it is never a good time to switch to something that you get just stuck into or an inferior strategy. So let's just show you what this has shown. And this has just shown one straightforward example where if you're started investing in the year January of 2000, put $1 million in a portfolio in January of 2000, and then very aggressively did all tax loss harvesting, then what you would see is you would get a lot of tax losses in the first year, and that those would almost completely disappear after a few years, and you just get a little benefit again during 2008. But basically, we've looked at this through many periods in history, and that's what you find is you get about half of your value of tax losses in the first year, and then it rapidly disappears. And you're stuck in a inefficient version of the S&P 500 ETF or something like that, and you're paying a lot more fees. So I just would want to caution people from that. So to just summarize here, I'd like to give people a few key takeaways, things that maybe they can talk to their clients about to put things into perspective. One is the graph you saw from Joy, which showed just really what a historic loss of global wealth 2022 has been. If you think about all the assets, all the stocks, all the bonds, and all the real estate around the world, then there's a greater loss of wealth in 2022 than there has been almost any year, perhaps, since the Depression. So recessions are possible, but the market knows that. So that's not a reason all by itself not to invest. And if you think about stock returns in similar situations, they're quite positive. Bond yields are finally giving you some reason to buy bonds. And when you put it all together, there's a lot of volatility. No one of these things is guaranteed to be right. But thinking about casting a very broad net, thinking about investing in global economic growth, and this does tend to be the most reliable investment strategy for investors to stay with over time. So thank you. Looking forward to questions.
Great. Thank you both, Robert and Joy, for digging into a lot of that. We had some questions come in, and we've had some that came in pre the webinar. So what I thought I'd start with here, we have one that came in from Steve over the webinar, and then that ties into another one from John that we had earlier. It really is around the same narrative where, nowhere to hide. What is the narrative for riding out a market environment that appears to have no traditional places to protect negative performance?
Yeah, so I can take that one. So I think this is a great question because it is very true. There's nowhere to hide. And I think there's no one right answer. But I think there are 2 points that we have been making during the webinar. And I really like Robert's key takeaway. So which is first, we are experiencing the biggest losses ever. So selling or cashing out guarantees locking the biggest losses. And it's important to remember that in the long term, capital markets reward investors for assuming risk, for staying invested, especially during bad times. And second, future remains highly uncertain. And we know bond, fixed income, and equities investing have been much riskier than before, and they will likely remain risky. So in this particular time, you do not want to place your bets on just one asset class or a few asset classes or just one economic scenario. You still want to stay diversified for protecting your long-term wealth.
Thanks, Joy. And I like the point about there's no single safe asset class. And we talked a little bit about the conservative investor's dilemma in the past, which has been particularly challenging because normally in the normal market environment, there are some very safe asset classes that you can be depending upon to provide some stability to your portfolio. And right now, investors are faced with losing to inflation for sure, or hoping to beat inflation, but having an awful lot of risk associated with that. And that is the environment we're in. There is no actual solid answer to that other than putting $10,000 in an I bond that people can actually solve this problem with.
I knew you'd find a way, Robert, to talk about I bonds at some point. So thanks for weaving that in there. Great job. This one is like Outlook. I think we had 5+ questions, and we're not big at New Frontier about making predictions, but the question has been, when is this going to turn around? Are we close to a bottom? When's the S&P going to get back to an all-time high? So can you just touch on what your food for thought would be on that for advisors that field that question from clients?
Yeah, so when you talk about when will the market turn around, my answer is always right now. And not that it will turn around right now, but that you expect it to turn around right now. If people didn't expect the market to turn around right now, the price of all assets would be zero. And that's the only way that it can be. So at every point in time, right, there's markets, buyers and sellers, and they have to agree on prices. And you have to incent a buyer to be willing to take the risk of holding a risky asset so that right now they're expecting it to go up. That doesn't, of course, mean that today is the market bottom and that it will go up. There's a lot of volatility here, and things will tend to go up and down over time. But the lesson for investors is, in hindsight, anything could have happened. This is a very difficult market because a more naive type of investor who just looked at the world and said, oh, the world's bad and interest rates are going up and we're going to have a recession and all that. And, all that gut would have been right. Usually the naive investor is wrong. And, but you have to say that there are times where it's right, and doing the naive thing would have been hard, would have been the right thing. And that makes it hard for a more sophisticated investor, a more thoughtful investor, somebody who tries to be disciplined, and because all the good advice you're giving people just hasn't worked. And that doesn't mean it won't work again, though.
Great, thank you. Next, like, let's just flip. There's questions on bonds. There's a question here on tips that came in from Kevin. Were we early on the call? Are you looking to add tips now that they're at a positive real yield? You want to touch on that, Robert?
Sure. So there's the one thing that's very clear about tips is in a taxable portfolio, when they're giving this much income, just don't have them in your taxable portfolio. Whereas investors in general might be very tempted to own tips because, for one, there's inflation out there, and it is true that tips dampen inflation volatility, but it is not true that tips solve the problem of inflation, because when inflation, they still have duration associated with them. So when interest rates go up in an unexpected way, then they're going to lose value like any other treasuries. So how we model them was that tips sort of cut the risk of inflation in half compared to other bonds. And so they were helpful in the portfolio going in, because we knew a year ago that inflation was coming. Did you want to add anything?
Yeah,
Right.
So I think people were asking about fixed income, and I think Robert has already touched a lot of good points. Here, I just want to add that market expectations have really changed a lot this year. If we look back, and as of the end of last year, bond markets were massively underpricing the rate hikes as a result of Fed's guidance, of course. At that time, markets are expecting 2 rate hikes for 2022. And now, if we look at today, markets are pricing in the implied rate of 4.5% by the end of this year. So what that means is that things are very different for bond markets. And I think that's something to remember.
Yeah. So bonds seem to be really popular. So there's another question that came in from John too, I thought was interesting. From our investment process, with the continued increase of global debt, through COVID and the financial crisis, how does global debt levels play into our investment process, and how we analyze that in the process?
That's a little bit of a tricky question, in that have been some theories about debt, and they made a lot of sense at the time, and they just haven't played out. And so we've tried to pay a little bit less attention to what are the global debt levels, and more of what is the market saying about the volatility of that debt. And the volatility of the debt is not great. I mean, that's been a big problem. Even though I said that real yields are positive, that doesn't mean go out and rush to buy bonds, because you're getting a little bit of return, but you're getting a whole lot of volatility. So it's not a great independent asset all on its own. Too much risk, not enough return. Story of too many asset classes out there.
Thank you. And then next, switching, Robert, to currency, strength of the US dollar. We've seen a massive strengthening of the dollar. How does that affect our strategies? What's our outlook on the dollar strength relative to other currencies?
We don't have forecasts, specific outlooks on specific asset classes. The dollar has risen, and you have to be careful of your tense there. The dollar seems very unlikely to continue to rise again as much as it has been. This has been very large. And if you look across all the currencies, if you thought from any other country's perspective and plot all other global currencies, you'd see the dollar as a huge outlier of what's going on. And in some sense, it does make sense that the U.S. market continues to be the most robust economy with the most robust market and the most open capital ways for investors. But that doesn't mean that the dollar can't go back down. I mean, a very, very simple understanding of things is that volatility works both ways. And so if it goes up quickly, it could go back down quickly. Certainly not predicting it goes all the way back down, but there is likely to be continued volatility of the dollar's value. And that could mean better things for investing in some international markets.
Great. And then one last question from around the allocations in the portfolio. Thoughts around the risk of developed and emerging markets within the portfolios and how to think about that when investing.
Yeah, so I think as we have mentioned, international equities are now riskier compared to US equities, and they might remain risky. So what that means for our portfolio construction is that we have to optimize risk exposure according to the risk mandate, as I talked about in my section, right? So our conservative portfolios, they have an overweight in US equities, underweight in international equities for the risk purpose. And whereas more aggressive portfolios, they have a higher risk tolerance. So in order to participate in global economic growth, we allow the aggressive portfolios to have international equities to provide more diversified exposure.
Great. And just a comment or question coming in, online here with the dollar so high, we're getting ready to look at some bottom fishing overseas. So it's, I think a lot of people are saying, is it finally time that, non-US has a stake against US equities?
That's certainly possible. I never quite understood bottom fishing. Like the lobsters are at the bottom of the ocean. They're pretty tasty. But we're not going to be specifically looking and to try to find the world's most undervalued market. They do look like a much better value from some measures, but there's almost always a very good reason for the values that you're getting over there. So we're not looking to say that prices revert and there's just much better deals, and so they must go up for that reason and then have big overweights there. The way that value tends to work in general is that if to the extent that anything does have a absolute low value, that must mean it has an absolute high risk of some sort. And certainly when you're looking at Europe, there's a ton of very obvious risks that are over there in the market. And so you don't want to be over allocating to Europe, and we haven't been over allocating to Europe. But that is, I think, how we view things. So don't work too hard into betting too much onto one of these very risky markets. But they hopefully should be increasing diversification and boosting returns to your portfolio.